Hi, I'm Jason Simonis. I'm also one of the partners in JSG Consulting. As Greg alluded to, we were a bit surprised by the transfer into a different company starting year 15, but we're excited at the opportunity and the challenges that were ahead of us with our new company. My history, very briefly, is I have a bachelor's in finance from the University of Iowa. I have an MBA from Elmhurst College, graduated in May of 2012. And I spent most of my career in healthcare and manufacturing. I'm a finance and strategy expert, and I have 15 plus years of experience in the consulting industry. So as I said, we signed on with Company C, which is Steve's Shoe Company, in year 15. So the first thing we did when we first joined the company was look at the company's strengths and weaknesses before we set out with a new plan for the company management team. So after doing some analysis of the numbers in the previous couple of years, we realized that the company had a lot of strengths, although it did have some weaknesses. The strengths are highlighted by a huge amount of market share. They had 59% of the private label market and 20% plus in wholesale. Given the industry, these are excellent numbers. They had very high celebrity appeal. It was very apparent that the company management previous to our joining the company was very interested in making sure that there was much capital invested in celebrities and advertising. They invested in advertising, and they of course invested in plant upgrades to help reduce costs, such as setup costs, which are very costly for most plants, and investing in these upgrades turned out to be very wise investments. There weren't a lot of weaknesses, but we did note some. One being they had a very low cash reserve because of the high investments they were making in advertising and upgrades, plant upgrades. They did have they had one long-term bank loan on the books, and they had very little Latin American presence, a major market where there was lots of demand, and we realized that they basically had no market share whatsoever in that particular market. So in year 15, here were the market conditions. In year 12, we experienced some inflation back when we were with Relevance, Company D. But not only were we dealing with inflation in year 15, we were also looking at higher interest rates and other economic turmoils, such as huge fluctuations in exchange rates between the different regions that we were doing business in. We decided that the company needed to maintain a very healthy cash reserve, which is in opposite of what they had done prior to us joining the company. We felt that with all the economic turmoil and the good possibility of some of the other companies going bankrupt, that it was a very smart and wise strategic decision on our part to have a very healthy cash reserve. Lastly, in year 15, two new companies entered the market. This created a lot of friction because they not only mirrored a lot of the other company strategies, but we realized that the industry as a whole had much more significant supply than demand. That really wreaked havoc within the industry. So, Greg, Steve, and myself decided to embark on a whole new strategy. I shouldn't say a whole new strategy, but a revised strategy for Company C to help propel it to further growth for the coming years. We decided to go, we felt the best option was to go with low price, low cost shoe manufacturing. We also decided that we were going to put profits before corporate citizenship. We also believed that because we had spent so much money in corporate advertising and celebrity advertising, that we felt we could take a little bit of a hit on corporate citizenship. It wasn't something we wanted to do, but something we felt we had to do in order to maintain the strategy that we were devising. We decided to increase the number of models of shoes that we would offer to the public. We increased our advertising expenditures even further with things such as retailer support. And we decided to explore Latin America, which was untapped for Steve's Shoe Company. So here's a snapshot of our results after our first year of being in operation with the company. Here we are right here, where there's a big circle. So we did a nice job here and here. Here's internet, here's wholesale, with maintaining and growing our market share. The results that were a little disappointing in our first year with the company, which was year 15, was the fact that we were still clustered. There still were a lot of companies fighting for the same consumer, both in the internet and the wholesale segment, and we decided we needed to craft a strategy that not only kept our circle big, i.e. our market saturation large, our market presence large, but also make sure that we started to differentiate ourselves and moved on the matrix. So here's what happened in year 15. There were some very positive results. Number one, in revenue, $480 million in revenue. Number two, in earnings per share, $5.72. Number three, in ROE at 18.6%. And a stock price of $94, which was second. Our credit rating was booming with an A rating and an image rating of 73, which was also first. So we were pleased with these results. So we were starting to feel more comfortable. After 3 years with Relevance and now 1 year with Steve's, we were really starting to get some confidence in the strategies that we were devising for this company. So our morale was pretty high. We were learning how the different levers of the market and of the company were really affecting our performance. We believed that our high quantity and low price strategy was really beginning to pay off, and we were investing in the future to continue to ensure our success. With that, I will turn it over to Steve.